So first of all, welcome everybody to our second whole group webinar of the Prime Microtrackers group. We're excited today to be hearing from the cluster of groups that are in the lending performance benchmarking group, to hear from them about what they've been exploring and starting to learn as they have dived into their learning questions and their project. Just a quick note around the technology and the logistics. We have certainly a manageable group today, so we're not going to be muting everyone automatically, but we encourage you to use the mute button either on your own phone or the conference mute controls if you know you have any background noise. So if you want to use the conference mute controls, *6 to mute. And just remember to *7 to unmute. So if you're talking and nobody is answering you, most likely you've muted yourself. So *7 to unmute. If you're having any technology issues, you can, if you're online, you can send just a chat message. We'll come to Jackie Orwick from our staff that's online supporting the webinar, and hopefully she'll be able to help you. If you cannot get onto the webinar, you can send her an email, but you're hearing my voice. Her email address is JackieO, JACKIEO @aspeninstitute.org, and hopefully she can troubleshoot with you. And as always, we welcome your participation. We encourage you to use the chat boxes as we're talking, and you have questions or comments, and then we can turn to periodically address them. You can also use your little raise hand button, which should be just above the chat box, which just signals to us that you have a question or comment. And again, just remember *7 to unmute yourself if you are planning to jump in and ask a question. And just to quickly reintroduce us, I'm Tamara Thetford, the Program Manager with the Field Program at Aspen, and I'm joined by my colleagues, Joyce Klein, who's a Senior Consultant with Field, Elaine Edgecombe, who is the Director of Field, and then by Luz Gomez, a Consultant with Field, and Marian Daub, a Consultant with Field. And we will be hearing primarily today from Joyce and Luz in terms of our staff that'll be leading us through the work that they've been doing leading this lending performance benchmarking group. And we all met virtually, which is obviously not the same as in person, but we saw each other's pictures back on our first whole group webinar at the end of February. So just to remind you that these are the folks that we've been working with at Coastal Enterprises. So we are happy to have Jennifer and Elizabeth on the phone with us from Coastal. And we also have on the phone with us Martin and Josh. And so we're joined by all 4 of these folks, and we look forward to hearing about their work to date in just a minute. So welcome to our speakers as well as all of the participants that are online. But I wanted to take just a minute to kind of lay out again for you how this project is evolving as we have gotten to know the groups a little bit better and understand what your specific questions that you're looking to learn. And as we looked at your proposals in the beginning and then actually started to work with our different groups, we found that there was a range of guidance and support that we would be able to provide to you. So ranging from some issues that current microtracker data could provide helpful insights on, and where existing analytic tools on the website would enable you to do the type of benchmarking that you wanted to be able to do as you outlined in your research questions. There were also some cases in which we had microtest data that's not yet on the microtracker site, but that we could perhaps analyze in some new ways or dig into, and then offer some context or points of comparison. And then there are other issues on which we feel we can offer guidance on how to think about collecting or analyzing data based on our experience working on these issues, as well as observation on how some other programs have tackled certain data questions. And so finally, in some cases, we're looking at referrals for you to peers that may be addressing some similar questions, whether within this larger Prime MicroTracker group or just within the microenterprise industry overall. So folks that would have experience either similar to yours or that you may be interested in. And we'll hear in the presentations today a little bit about this range of how we're starting to work with each of the groups. But also just to refresh you in terms of benchmarking, there's definitely different types of benchmarking that became very clear as we read all of your proposals and now are working with you on your research projects. A few of you are interested in benchmarking your organization against your peers with respect to certain metrics. More of you are interested in doing some internal benchmarking, so this you to you, comparing the effects of one program service to another. And then there were some that were really interested in external benchmarking. So not necessarily just against your peers as much as against other economic development strategies with which your programs are often compared. And then some of the groups are interested in looking at, in addition, effects over time and how different cohorts that they serve compare. And so as we go through the first two presentations and then we do a quick update on our other learning clusters, I think we'll start to, it'll make clear these different approaches and kind of focus of what type of benchmarking different organizations are really looking to do through this project. So I'm going to go ahead and turn it over so we can start to hear a little bit about, I think we're going to start with Community Capital of Vermont and what they've been working on and learning.
Great. So this is Joyce. Thanks, Tamara. And I'm going to walk us through what we've been doing with both of these groups, and Luz is going to pop in a little bit. But let me just say, we were obviously we are the first group to report out, and one of the nice things about going first, or one of the reasons I'm glad we're going first, is we actually are going to touch on all four of these areas that Tamara just talked about. We are looking at all these different kinds of ways that we thought we could help you. We're doing between the two groups that we're working with and we'll be talking with today. So we're going to start off with Community Capital of Vermont, and just to remind you, we're working with Martin and Josh there. And both Martin and Josh were relatively new to Community Capital of Vermont, so they're really looking at the work of the organization with fresh eyes. And as you'll recall, we asked you to posit some key questions that you were interested in looking at and some hypotheses when you submitted your proposal to us. And so for Community Capital of Vermont, their sort of overarching question was whether they're deploying their capital efficiently and effectively relative to their peers. So Community Capital of Vermont is a credit-led microenterprise program. Their focus is on deploying capital to folks who need it in Vermont, and so the question is, are they doing that efficiently and effectively? And in particular, their hypotheses about their work were that they thought their loan loss rate and their portfolio at risk were comparable to peer organizations, but they thought that they were relatively inefficient in terms of getting their loan capital out on the street. So in terms of getting a handle on those questions and those hypotheses, we started with some measures that Martin and Josh themselves identified in their proposal as being some measures that they wanted to be able to compare themselves to their peers against. And we actually added some more measures based on what we knew we collected, not only through microtests but also through the census. And so we thought that we could, by adding a few additional measures, give them an even more robust sense of and some more insights into these questions that they were posing. So what this slide gives you is a sense of the measures that we identified to look at in the benchmarking process. So some of those measures are related to the scale of their lending program in terms of the loans that they're dispersing. Some of them are related to the deployment out of their loan fund, the average loan size and the amount of their capital that they deployed, and also some relative to this question of what the risk in their portfolios, so looking at things like restructured loan rate and loan loss rate and portfolio at risk. And then a third area of measures that we looked at with them are some cost and efficiency measures that look at how cost effectively they're deploying their capital and managing their capital, and also a sense of how much cost recovery they're doing in terms of the revenues they're generating through their lending process. So one of the things we did first with Martin and Josh was to develop their own data on these measures. So Community Capital of Vermont had not been Microtest members in the past, and so what they did is they filled out the data preparation sheets that Tamara shared with those of you who are all new to Microtest. And we worked through the process of making sure that data was clean and consistent with the Microtest definitions. And we focused in particular on the measures that they were most interested in the ones that we selected for them to benchmark themselves against. And we're actually still working through that process a little bit, although I think we're very close. The next thing that we did is we worked with Community Capital to identify the peer groups and the organizations that they would benchmark themselves or their organization against. So as I mentioned, Community Capital of Vermont is a lending program. They operate statewide in Vermont, which most of you probably know is a very rural state. 72% of its residents live in rural areas. I think one of their colleagues, we were actually just fortunate to be up in Vermont doing a site visit for something else, and we were able to meet in person with Martin and Josh. And I don't think it was one of you two, but one of your colleagues mentioned that Vermont is the second most rural state in the U.S. So what we chose to look at in terms of peer groups, we chose to look at all microenterprise programs that did lending, all microenterprise programs. We proposed to look at those that identified themselves as being credit-led. There weren't actually any lenders in the Microtest group who identified themselves as being solely rural, but there were a number that consider themselves dual area, which means they lend in both rural and urban areas. So we looked at the dual area programs. We looked at the programs in Microtest, the peer group that identified themselves as statewide programs. And we also selected 3 individual programs which had given us permission to share their 2010 Microtest data. And we selected those 3 organizations based on some similarities between themselves and the Community Capital of Vermont. So we looked at organizations that were operating on a statewide level, that were serving some rural areas, and that had somewhat similar average loan sizes. And so the 3 organizations that we selected for Josh and Martin to benchmark themselves against were Mountain BizWorks and Mercy Corps Northwest, and the Wisconsin Women's Business Initiative Corporation. So Mountain BizWorks is a credit-led program that operates out of Asheville, North Carolina, so it has a fairly rural population, although Asheville is in itself a city. Mercy Corps Northwest, which is based in Portland but operates statewide in both Oregon and Washington State, and WIBIC is based in Milwaukee but also lends statewide throughout Wisconsin. So, and one of the things that was nice about the choice to pick WIBIC was that Martin had just heard and met Wendy Bauman, who's the head of that organization, the week before. We actually met to talk about this, so it gave some good context for him of what that organization was about. So those are the peer groups and the individual peer programs that we're going to benchmark Community Capital of Vermont again. So Luz, now if you can switch to your screen, what we did next was we created a spreadsheet that laid out all the measures that we wanted to look at. And if you go to full screen, Luz is going to try to make this as big as she can, but for those of you, if you go to full screen, you'll be able to see this a little bit better. And we're not going to spend a whole lot of time, and we'll go to something that's a little easier to look at in a second, but we just wanted to give you a visual picture of what it was we did. And so what we did is we created a spreadsheet that laid out all of the key measures that we were going to benchmark against, and then provided columns both for Community Capital of Vermont's data and then for all the different peer groups that we were going to compare to. And then what we did is we at Field filled in the column for Community Capital of Vermont. because we needed to crunch through the data that they had sent us ahead of time in terms of their own lending activities, and we filled in that data for them going through the ratios, et cetera. And then what we did is we went ahead and sent the spreadsheet with blank columns in it off to Martin and Josh. And because some of this data is currently available through microTracker, Martin and Josh took a shot at filling in as much as they could from that source using the website. And at the same time, on our end, what we did was we worked to pull together data that's not yet available through microTracker, and that includes in particular the data from the individual programs like Mountain BizWorks and WIBIC. And we pulled that from our own internal data sources, and in the end we compiled this spreadsheet. So I just wanted to, before we go on, I wanted to just pause briefly and ask how many of the rest of you, obviously Martin and Josh have been on microTracker, but ask how many of the rest of you have been on microTracker to see, aside from whatever demos we've done, to see what kind of performance data there is and to see how you can compare yourself to others. And if you have been on it to play around with it a bit, if you could use the raise hands function to just raise your hand. Anyone in the group been on microTracker to do that? Or you can shout out if you want to, if you're not muted.
I'll shout out.
And who's that?
Hi, this is Malik Looper from Renaissance Entrepreneurship Center.
Oh, great. Terrific. And can you tell us what it is you've done on microTracker?
I can't. Oh, my answer was no, I haven't.
Oh, no, you haven't. Okay, okay, great. Okay, well, so what we're going to do right now, we thought, was because we figured that there would be some of you who didn't do that, but we know that several of you have expressed an interest in using microTracker to do this kind of benchmarking work. So what I'm going to do is turn it over to Luz for a few minutes, and she's going to give you a quick tour of how you can use microTracker to kind of get to these kind of numbers and put together a spreadsheet similar to this one that we did with Martin and Josh.
Great, thanks, Joyce. So you can see that I'm on the microTracker page. Again, if things look a little too small, you can also hit full screen on the top right-hand corner. So you can see that I'm logged in. Hopefully everybody has credentials, and try out your credentials if you haven't yet. And so I'm just going to take you through this section where we have our benchmarking data, which is the Analyze section of microTracker. So once you get to the Analyze section of microTracker, we have data sets broken into different buckets. So we have this bucket of size and diversity, microfinance volume and performance, business development services volume and performance, and the cost and sustainability of micro. So to pull this data, Community Capital of Vermont used these three buckets: size and diversity, microfinance volume and performance, and the cost and sustainability of micro. So I'm going to take you into this section of microfinance volume and performance just to give you a flavor of the different functionalities in this section. So first of all, we have the bucket of the raw data. So these are basically data tables of performance data for organizations, again, that report into microtest. And so I'm just going to give you an example of what that looks like. So we have a bit of trend data here, or historical data here, from 2008 to the most recent of 2010. So I'm going to go into this and try to give you, hopefully it's not too tiny. So you can see here these data tables, a number of measures here on the left, and then different cohorts that are reporting into, that we've cut in different ways from those that have reported into microtest. So we have all programs reporting, both the averages as well as the program medians, the minimum maximum of that data, for the cohort of credit-led programs, cohort of training-led program medians, and then the top performing 1/5 of programs reporting into microtest. So again, this is more of the raw data that you have access to in this section. Community Capital of Vermont was able to pull a number of the measures and the data from that section. And then we also have a section that we call Quick Reports, which are, again, charts and graphs that we've put together, that we've pre-made for you. And this incorporates both historical as well as current microtest data. And so I'll give you a flavor of what that looks like in this section of microfinance volume and performance. So again, it brings together different ways of looking at the data. So we're looking here, for example, in this chart of measures like micro loans dispersed, small business loans dispersed, small business loans leveraged, etc. But it buckets them, it puts them in buckets of low volume lenders, how they performed across these different measures, medium volume lenders, and then high volume lenders. And we have definitions of what those are here. And so this gives a sense of looking at your data or benchmarking yourself in context to similar peer groups. So that's one example. Again, we have here dollars dispersed. Here's another way of looking at it. You can take a look at these measures of deployment rate, portfolio at risk, loan loss rate. We have all programs reporting into Microtest. We have lending-focused programs, training-focused programs, and then low-income-focused programs. So again, another way to cut the data depending on sort of the questions you're looking at. And then finally, just down here below, you'll get a snapshot of Microtest data from 2006 to 2010. So if you're interested in looking, for example, at portfolio at risk and loan loss rate over time and how that's changed, you get a sense of that here through this. And for all of these, graphs, you'll be able to actually view the data table as well. So it's right at your fingertips. You don't have to sort of manually crunch any numbers. These are sort of pre-made and a little bit easy for you. And we try to pick out key indicators so that you could evaluate and easily benchmark your program. So the last section I want to take you through is our report builder section. And so this pulls from a wider data set, those programs that are reporting into the census. And so you can really drill down a bit more here. You can look at specific organizations. You could look at specific statewide data. And then what you find here are really looking at indicators of scale. You can look at demographics across the industry that responded to the census, as well as some indicators of cost and efficiencies. So what I want to do is just build you a brief report and give you a flavor of how Community Capital used this section of Microtracker. I'm going to go ahead and build a quick report. So here, it'll take you, this sort of easy widget will take you through 4 areas so that you can hone your data. I want to use fiscal year 2010 data. And I'm going to be looking at these 3 indicators. So microloans dispersed, microloan dollars outstanding, as well as a mean loan amount. So I'm going to unclick all the rest of these indicators, but you can see the breadth of types of information we have here. Click Continue. And then I'm going to choose individual programs to benchmark against. So let's say I'm Community Capital Vermont. And then I'm going to choose the different programs that they wanted to individually benchmark against that we recommended for them. And I'll hit Continue. And here you can even hone even more closely. So what I want to do is I want to pull in some data on Vermont as well, just to see what that looks like. So I'm going to go ahead and choose Vermont. And if I wanted to, I could even hone the data a little further, let's say by area served or product or service offering or a number of indicators you see here. I'm not going to choose any of these right now, but you can see the breadth of indicators that you can go ahead and choose. I'm just going to go ahead and continue. So you can see here side-by-side comparison along these three different areas that we looked at: microloans dispersed, average loan size, as well as microloan dollars outstanding. You can see Community Capital of Vermont here. You can see how Vermont, the three programs reporting census information from Vermont, some of their data compared. And then you can see Mercy Corps Northwest, Mountain BizWorks, and Wisconsin Women's Business Initiative Corporation here. And then it pulls in also this last one, or the national median for all programs reporting into the census. So again, you could also view the data table there. And again, you can play around with the different indicators. If you want to change something, let's say you wanted to change a specific program, you can go back and potentially unclick and then sort of do that process over again. So again, it's pretty user-friendly. You can pull in, play around with lots of different indicators. And again, this is pulled from a wider data set of the census for programs reporting in to the census for the years that we have there. So any questions from folks regarding the microtracker functionality of the Analyze page?
You can feel free to just speak up if you have a question.
Yeah, I can speak up, or if something occurs to you along the way, we can also write it in via the chat, and we'd be happy to address it along the way. I wanted to just encourage you to play around with the site until you feel real comfortable. And I think the more you play around with it, the more insights I think you can gain from the data that you have here. So great,
Hey.
Trace, do you want to?
Hi, it's Rob Martin with United Virginia. We just, this is a great application and looks very promising. And I'm just curious, is it only the organizations that have opted in that are represented on here? Like, how do you organize the comparison analysis that you're doing? Because I know there are other organizations that would be good reference points for even this institution in Vermont that aren't represented in their analysis. If we were going to do some of our own tabulations according to our peers using this tool, how do you gauge who you can compare with?
That's a great question. Joyce, do you want to talk through some of the reasons why you chose these for point of comparison?
And how we know that. And Tamara, I may ask you to jump in here as well. So one of the things that you can do is for the functionality that, that Luz just showed you, where you can pull up individual programs, any organization that's reported, that's listed on the census, you can try to pull that data in, and it'll pull in whatever data we have resident in microTracker on that organization. So if they haven't reported that data element to us, it might show up as a blank. But if they've reported that data element to us and you use it on microTracker like that, it will show up if you use this functionality. The other piece that we did for, and the reason that we identified these, the three programs that we did, is we've gone back to our folks who have reported to us through microtest in the past, in some of the past years, and asked for permission to share their data. And we're creating the new profile pages so that folks can report more data, and we can include past microtest data. And that's beyond what's been folks have been reporting in the past. And so as folks share more data, the stuff that is imported, that's entered into microTracker, will show up through the microTracker database. And then in addition, for purposes of this analysis, we were able to go back to our data sources and pull that data directly, because it's not in microTracker yet. We were able to pull that directly for Martin and Josh so they can look at it. So we looked from the list of organizations that we knew had provided us access to their data and the ability to share their data, and we selected the groups based on that. Does that answer your question?
Absolutely. Thank you.
Okay, great. Tamara, do you have anything else you want to add on that? Or?
No, I guess just to say that, so what we are working towards, and for anybody that has ever done a web development project, it just has taken a little longer than really we had hoped. But what we are very, very close to is all this type of kind of further analysis and peering in and figuring out who the good comparison programs would be that Joyce and Luz have done manually will be, more of a process that you could do directly on MicroTracker as we're able, very soon to do what Joyce said, where all of this kind of microtest data that folks have shared in the past and then going forward that we collect from more of the industry will be in MicroTracker. There will be no separate, we have to go to our own files kind of piece. So that piece of it should get better and more accessible to everybody that wanted to do this. But for the timing right now, Joyce and Luz kind of stepped in and played a manual matchmaking comparison process.
And this is Elaine. Hi, everyone. I also want to just say, Rob, if you have some suggestions of organizations you think it would be interesting for Community Capital of Vermont to look at, why don't you shoot the names of those organizations to them and to us, and if they're in the database, Martin and team might want to look at them. Certainly we picked a few that we knew we had some robust data on. But if there's others, it might be worth just like poking around and seeing what's there. Certainly, that's a valuable piece of information that one peer can share to another peer if you're aware of an organization that might be in the data set that we don't know well enough yet, but you know. So
okay,
please,
I'll be happy to do that.
Yeah, please feel free.
All right.
Great, thank you. So we just wanted, hopefully that was useful to folks. We knew that there were other folks in the group, even though you weren't necessarily focusing on a benchmarking process right now, that were interested in using the tool in that way. So we wanted to give you a sense of what it was like to use that tool. And obviously for folks who may not be lenders but are more training and TA focused, there is a section and access to measures that relate more to the training and TA work that you do. And Luz is going to, I think, show you right there. Luz, if you want to go back to the page that shows the categories of measures, folks can see what those are there. But obviously we wanted to make sure you knew how to get the data, but really obviously the interesting piece is not how you get the data, but it's what the data tells you and where it leads you. And so what we'd like to do now is turn to that part of Community Capital's experience. So Luz, if you can go back to the spreadsheet. And we're going to look at a slightly narrowed down version of the spreadsheet. When we were speaking with Martin and Josh in terms of talking about this event and prepping for this webinar today, they expressed an interest in really hearing from the rest of you about what their data might tell you, or how you might look at their data and what kinds of questions it might raise in your mind. So what I want to do is just, again, if you go to full screen, you'll be able to see this a little bit better. But what we wanted to do is just walk you through some of the key measures that they're looking at and thinking about. So as you can see, again, down the far left-hand column, we have the measures that we're looking for. And in particular, the ones that they're most focused on is they were interested in comparing themselves to credit-led programs, to statewide programs, and in particular to Mountain BizWorks and Mercy Corps, which were really closer in size to where they are right now as compared to WIBIC, which is a much larger organization. And so we looked at, you can see here, number of loans dispersed, and you can see that Community Capital is on the small end there relative to the other folks that we're comparing to. Again, value of loans dispersed, dollar value of loans, smaller than the rest except for Mercy Corps, where they're spot on in terms of the number of loans dispersed. One thing I should note here is we have 2011 data for Community Capital of Vermont, but we're comparing it to 2010 data from the folks in Microtest, because the most recent data we have right now for Microtest is 2010. We're a little bit ahead of the curve for you guys, so that's important to keep in mind. In terms of the dollar volume of loans outstanding, again, somewhat smaller than credit-led programs and statewide programs, and slightly smaller than Mountain BizWorks. In terms of total capital available, again, slightly smaller than those other three, but larger than Mercy Corps. Their deployment rate for their capital, you can see, is lower than all of the rest. And you'll see that one of the reasons that Mercy Corps Northwest was relatively small compared to the others because they loaned out all their capital. So their big issue, obviously, is needing more capital. Another thing, if you look at the next row, average loan size, Community Capital of Vermont's loan size in 2011 was pretty significantly larger than the rest of these peer groups or individual programs. The percentage of their portfolio that was invested in startups was high relative to the two peer groups at 66%, but about the same as Mountain BizWorks. The percent of their clients who were low income is somewhat higher than the rest of the groups. And then in terms of some of the risk measures, you'll see that their portfolio at risk is higher than the two peer groups and higher than Mountain BizWorks somewhat significantly, although somewhat lower than Mercy Corps. Loan loss rate the same as the other individual programs, but slightly higher than the credit-led programs and microtest and the statewide programs. Restructured loan rate also sticks out as being higher than most of the other groups. Their cost per loan is on the high end, except relative to Mountain BizWorks. Cost per client is about average. One thing that sticks out, if you look at the next measure, their operational cost rate. Oh, let me just go through some definitions here so folks are clear. For all of these ratios, what we're doing is we're looking at the operating expenses of Community Capital of Vermont's operating expenses, and then looking at a number of different ratios relative to those operating expenses. So in the cost per loan, we take their total operating expenses for their credit program. And in Community Capital of Vermont's program, their entire program, their micro program, is just about lending. They don't do training and technical assistance that's separate from lending. So all of their operating costs are really related to their lending program. So in this case, we're dividing their operating expenses for that loan program by the number of loans dispersed, and that's their cost per loan. And you can see they're on the high end there, except relative to Mountain BizWorks. In terms of their cost per client, we're taking their operating costs for their lending program and dividing it by the number of clients they served. And for them, that includes not only folks, new loans made in that year, but also folks with existing loans and other folks who they were working in the loan process. Then we look at their operational cost rate, which is also, again, taking their operating expenses and in this case dividing it by their average outstanding loan portfolio for the year. So that gives us a sense of what it takes to make and manage all the loans in their portfolio. And you can see their operational cost rate actually looks quite good. So in that case, because that number is lower, it means they're more efficient. It costs them less to manage each dollar in their loan portfolio. And then the final ratio is their operational self-sufficiency, and that looks at the income that they generate off their lending and divides it by their total operating expenses for their lending. And so you can see there that, again, they're covering 52% of their operating expenses with lending-related revenues. And that's fairly strong, fairly high compared to the rest of the folks in the sample. So those are some of the measures that are really directly, again, related to some of the hypotheses that Martin and Josh were interested in looking at, which were namely, were they deploying their capital efficiently and effectively? Where were they in terms of both some efficiency measures and in terms of their loss rates and their portfolio performance relative to some of their peers? So Martin and Josh wanted us to ask all of you what you thought of that data and what kinds of reactions, insights, questions it posed in your mind. So I'm wondering if folks can, if anyone wants to share with us how they respond to that data. And you can just speak up. I'm not sure folks can see the raise hands function. So you can certainly chat to us if you can get to the chat function, or you can just go ahead and speak up if folks have some insights they want to share with Martin and Josh. Any reactions to the data? Elaine, do you have any? I know you had a chance to look at the data somewhat in advance, so you might have a little bit of a leg up on folks.
Yeah, well, I guess I have a number of reactions or things that if I were they, I'd want to explore, and I'd love to hear what they were interested in exploring. So, clearly some of their measures of risk are higher, portfolio at risk and restructured loan rate. numbers are higher than many of the numbers we see marching across the spreadsheet there. And when I looked at the amount of money they had invested in startups, it was pretty substantial, especially with respect to the group cohorts we have there, the credit-led programs and the statewide programs, although it's somewhat similar to Mountain BizWorks. But looking at the cohorts, they're pretty highly invested in startup lending, which is a risk factor, and their average loan size is relatively high compared to the others too. So, it makes one want to understand why those loan sizes are as high as they are, especially when you have a portfolio that's tilted pretty substantially towards startups. And does that increase one's risk? And if so, and if there's reasons why you want to do that or you need to do that kind of lending, how else can you mitigate that risk? So that's one of the areas that I saw in the data that I thought was really interesting.
Okay, great. Thanks. And we also, we had a comment from Josh Sheldon for Martin and Josh, and his comment is that the question for you guys is how much post-loan support you all do, because Josh notes in the chat that compared to BizWorks, your risk and your restructured rates seem high, and that raises the question of whether this could be mitigated by more support after the loan is made. So Martin and Josh, I don't know if you want to have any thoughts about that or want to respond to that comment.
One of the questions this is Martin, one of the questions we asked Joyce and Luz when came to Vermont, it was great to be able to meet one-on-one, was can you correlate loan performance and access to technical assistance? And the answer was we're not sure. It's because it's a complex question. What kind of technical assistance provided by whom and what subject area? So I think clearly one of the things that our data points to is we're not effectively working with our current borrowers to help mitigate risk. What we need to understand better is, can that be addressed through increased technical assistance, and if so, delivered in what manner? So it's a really critical question for us.
Yeah, Josh and Martin, and this is Joyce again. I mean, I do think we did also have a conversation about whether post-loan technical assistance and collections more broadly was an area that you wanted to focus on, because I think, noting a correlation there that, your risk rates are higher, but also your expenses are lower, and possibly that may mean that there's a need to sort of shift some additional focus on some of the post-loan technical assistance.
I think that's right. You could look at our operational cost rate and say, wow, that's really good. Look how efficient they are in using resources. Conversely, you could say we're not spending an adequate amount of resources on supporting our current borrowers, which is what I'm inclined to say. So just as a quick aside, we're a staff of two and a quarter, essentially, with 2 new staff people. I think one of the things that we're seeing is weakness in the portfolio because of a fair amount of turnover in staff over about an 18-month period.
Okay.
Yeah, this is Elaine again, and just wanted to comment that issue that you just raised, Martin, about do we know anything about the relationship of technical assistance and lending performance? Right now, as Joyce said, we don't know a lot, but one of the other organizations in this project, Work in Philadelphia, wants to try to look at that question either using some of the data they've already collected in the past or using their outcomes tracking this summer to try to look at differential outcomes of their clients and see which loan clients happen to have received more TA than others. So there might be some insights into this that we may get from a couple of the others this summer, but clearly it's an area that I think a lot of work hasn't been done in yet. So let's see if there's something to come from their work. And I don't know about United Virginia. I think Rob, that was an issue that you were thinking you all would want to look at in your outcomes tracking this summer as well. You might want to comment on that.
Yeah, actually, I just sent a note mentioning how relevant this analysis is to our organization. Even as it is done independent of our organization, we can really take valuable insights. And we've made loans where we've provided significant technical assistance, and we've also made loans where we haven't, and we've used strategic partners with varying degrees of success. And so as we look forward, we can compare this model and this comparison to think about how we might better study what we do.
Yeah,
this
thanks.
is Martin. We would love to hear the outcome of that over time.
We're happy to share, as you have.
Okay, great. And the other thing I want to do is I just want to see if I can get Josh Sheldon, who's been making some really interesting comments via the chat, to actually join us verbally on the phone, because Josh, you made a couple additional comments about potential trade-offs that community capital might be making. So do you mind just sharing some of those, some of your thoughts with us on the phone?
Yeah, absolutely. So there's a couple things that jumped out as well. When Martin said that you guys have had some staff turnover, that sounded about right, that maybe your overall loss rates are going to be a little bit higher than they actually are right now, and that's sort of a lagging indicator, just based off of portfolio risk and restructured rates. And the other thing, though, is that there's potentially, if there's a trade-off, that if you can, in fact, keep that loss rate low and you're just comfortable having a little bit more payments being late and restructuring more of the loans, and just accepting that there's going to be a cost of capital and the payments coming in a little bit slower, you might, be comfortable just keeping your costs low and accepting that as part of the trade-off, and not really growing that technical support after the loan. Just making a decision that you're willing to bear that little extra risk, and that what costs are associated with that are not as great as the costs that would be associated with actually staffing up to mitigate that.
It's a really good perspective.
Yeah, I was just going to chime in. I think that's a really important thing to keep in mind. I mean, obviously, managing risk is at the core of what you're doing as a lender. But I do think it's important to think about what are the relative costs of managing that risk and keeping your portfolio in good shape relative to the losses that you incur, or some of the other costs that are just incurred in managing if your payments aren't coming in on time. But those late payments aren't necessarily materializing into losses at the end of the day. It just may be that it's more unpredictable in terms of your cash flow. So yeah, I think it is important to think about what are the costs in terms of loss of capital versus what are the costs in terms of what you'd have to put into staff time to take that on. And interestingly, we had somewhat of a conversation about this when we were up there, Martin, because you led off our conversation by saying that you were thinking about participating in the SBA microloan program. And one of the things that would bring to you is some additional funding to support the kind of post-loan training and post-loan technical assistance that to date you haven't had a lot of resources to dedicate to. Because you've not been an organization that's raised a lot of additional grant money to help support those operating costs, which is one of the reasons you're a lean machine, is because you haven't had those additional resources to be able to expend. So I don't know if there's anything else you want to share about that. Or
You're exactly right. I anticipate we are going to apply to be an SBA micro loan intermediary, which requires primarily post-loan technical assistance. And there is certainly a reward to that comes with some funds from the SBA to cover a cost of the technical assistance, but there's also a cost, which is managing the SBA and your relationship with the SBA, and the reporting is a real pill from what everybody says. So I take in to consideration the question of, will we in the end, will our loan performance improve enough to justify that additional overhead and cost? And I'm not entirely convinced. Anecdotally, you would think it would be true, but I'm not yet convinced.
Okay. So any other comments from folks or insights from looking at the data and reflecting on it?
This is Elaine. I would just also suggest that you look at your average loan size and understand why that's such a comparatively larger number than the average loan size for your peers. And so is there a way you can mitigate risk perhaps by starting out with a somewhat smaller loan with some of these borrowers and then build up as you get more experience with them and they demonstrate their capacity to repay? So, not being able to look inside those loans, it's hard to say from the outside, but it might be an area that's worth taking a look at.
Thank you, yes.
Okay, great. Okay, well, I'm going to go ahead and move us on. But thank you to all of you who chimed in and added your thoughts there and provided your insights to Martin. And to Martin and Josh. So what we wanted to do now that we've heard a little bit from you, is to give Martin a chance to share and Josh a chance to share some of their reactions and experiences with the work we've done so far. So, Martin, I wanted to you're going to lead off here. I was going to ask if you could just first give us some thoughts about what you've learned so far about the hypotheses you posited in the beginning of this process.
Some of you will remember that Tamara asked the question a month or two ago, what will be your headline when you've completed this project to describe what you've learned? And I sort of smart-ass said, well, prove how awesome community capital is. I think it's fair to say that the data is showing us the path to awesomeness, that we haven't achieved it, and the data really shows some weaknesses at community capital, which don't come as a complete surprise. But what I focus on is the value of the loans dispersed, the deployment rate, the portfolio at risk, and the cost per loan are all areas for concern, and would point to the fact that, in fact, we are not efficient and effective. And even the data that on its face might look good, like our operational self-sufficiency, is a sign of weakness because we've done very little resource development. We've not brought in a lot of unrestricted operating support to cover the cost of the organization. So we really have relied on loan revenue to our detriment. And all of this, I think, sort of boils down to what strategically is our single largest challenge, which is how to originate more loans to increase our lending, the number of loans and the amount of capital that's lent. And where Josh and I and the board have tried to understand is our deployment rate low because one of four factors: weak economy, ineffective marketing, competition with other social lenders, or we're offering a loan product that doesn't meet the needs of the borrowers. So we know we're not lending. We know our portfolio is not strong. Now we have to figure out what is the response to that. And that is the biggest challenge that we face, and that this data confirms is something we really need to focus on.
So now we've got a second question we wanted to hear a little bit from, and I think Josh is going to take the lead on this one. So one of the things that we had to work through in this benchmarking process was just making sure that you all had data that was comparable to the measures that we collect through both the census and in particular through microtests. So Josh, I just wonder if you could share a little bit about some of the data issues that we confronted as we were going through that process.
Yeah. We quickly realized that historically staff at Community Capital were not using our loan software appropriately and not entering a lot of the data that came in with our applications and financial statements, tax returns. So we had to actually hire somebody to come into the office and go through all the files and re-enter data, which was very time consuming. And then during the process, we also they would get done looking at all the files and entering data, and then we would say, well, what about this piece of data? Did you look at that? And so they'd have to go back over and look at everything again. So that was really frustrating, but it was also came back full circle to me personally, because although I'm new to the organization, I studied CDFIs in graduate school, and I knew one of the difficulties of the industry was this collection of data and the standardization of the collection of data. So it really just, was right there in front of my face that here's, field, they want this information, but we're only collecting, our definition of startup was any business less than 2 years old. We didn't capture pre-venture, startup and ongoing businesses. We didn't enter the income HUD information into our loan software. We would just calculate it then and then include it in our credit memo, and that's it. So it really emphasized how important it is to capture as much data as possible and to have that available to use to compare to peers. And so we also learned some lessons that we need to revise our application and reformat it, add some data collection features, get rid of some, and we also learned that we weren't using the loan software appropriately, and so that's, there's a large emphasis on training on being able to use down-home loan and the user-defined fields to enter categories that we want data going forward. So it was a large process having to hire somebody and capture all this data, and it's still ongoing. There's a lot of data out there that we want to go through again and enter it to be able to use and going to the future. I wish 10 years ago the organization had realized this and had entered all this information, and because I think it would be very beneficial for us. But certainly we know what we have to do going forward.
Yes, and we're hoping that hopefully the way that you're doing this process, and I know you're working on, your intent is really to set it up so that it's not just pulling it together for this 1 year, but you're setting your systems up so that you can do this year after year and begin to get some of that you to you data, not just the you to peers data that we've talked about. So
right. Yeah.
Great. Well, thanks. Well, Martin, I'm going to ask you to sort of compress the last two questions here. So because you talked a little bit about, when you answered your question about what you were learning about your hypothesis, about what new questions the data generated in your mind. So I said to you, one of the things that I like about data is when you look at data, you have a question and then it always asks, it always creates some new questions, which means you're always in a learning process, which I like. But it can be maybe a little bit frustrating. But if you can talk a little bit about if there are any other questions that the data has posed in your mind in addition to the ones you've already shared, and then what are your next steps at trying to work within the organization and work with your board to try to move forward in terms of improving the practices that you see might be challenged right now?
Great, thanks. In terms of new data or new ways to look at the data, 3 areas, 2 of which we've already touched on. First, as Elaine pointed out, is one thing that jumps out is our loan size. And I'm not sure how to correlate loan size to risk. So, for example, we could have our maximum loan size is $50,000. We could have one $50,000 loan that is 60 days delinquent. Another organization could have 3 $10,000 loans that are 120 days delinquent, but yet our portfolio will show as more risk. And is it, in fact, I don't know how to weigh loan size and risk. I would have thought intuitively that a smaller loan is a riskier loan because the entrepreneur is starting undercapitalized. Generally, I think of the amount to start a successful business as being greater than what are some of our smaller loans, $5,000 to $15,000. So, but the problem is that one big loan goes bad, it sort of throws off all the measures. So that's one question. Another question that we want to have a better understanding is the role of technical assistance in portfolio performance. And to drill down just a little bit on that, what I think is most important is what type of technical assistance in what area. We can build our capacity in only so many ways. And I'm inclined to think it's in terms of bookkeeping and financial management is really where we could provide the most value added to our borrowers. But I want to understand that from a data point of view a little bit better. And then lastly is what sectors of the economy are our peers lending to? We know what percentage of our portfolio is in restaurants and what percentage is to salons and what percentage is Main Street retail and what percentage is home-based business. And I'm wondering how we compare to others. And it may be that who we're lending to is what's driving our loan size and our risk as well. And there may be an unmet need, a need that others have identified and responded to that we have not. So I think there's a real opportunity if we know better who others are lending successfully to. Which then leads to what are we going to do next? What our next steps are is I have a board meeting next week. The spreadsheet that you have all looked at, we're going to send to the board, begin the discussion with them. That I think what the discussion is that I would like, we have a standard loan product, $1,000 to $50,000, amortized over 5 years, 9 to 11%. And I'd like us to increase the flexibility in our product in terms of term, rate, and amount to better respond to the market. And so that's my quick response to what the data is and what we'll ask the board to begin considering.
Mm-hmm. Mm-hmm. Yeah, I think the other thing that we had talked about, and it might be a potential next step, is this question of connecting with peers, and learning more about peers in two ways. And one may be, again, looking into practices around portfolio management. And looking at things like, getting to this question of, is a larger loan inherently more risky, and how do you value, whether a smaller loan to a more nascent organization is more risky than a larger loan to a more established business. And I think that has to do with issues of how you approach things like risk rating in your portfolio and how you look at things like diversification in terms of, and concentration in the loan portfolio in terms of concentration in loans of different sizes, and how that varies across different sizes of portfolio. So, many organizations will have a limit in what percent of their portfolio can be concentrated in a particular firm or a particular business. And so it may mean that you can't do a $50,000 loan to a business until even if that's your loan size, until you've grown your portfolio, or you can't do more than 2 loans, until your portfolio gets to a particular size. So I do think there are sets of practices out there about how to address those issues, and connecting to peers may be a really good way of sorting through some of those questions. And I know, Martin, that just again fortuitously you're planning to be in Asheville, where Mountain BizWorks is located, so there may be some opportunity to meet with them. I mean, I think the other thing that we had talked about a little bit was maybe the other issue, and this is something that MicroTracker can help you get a little bit of insight into, is that there are 2 other lenders CDFI lenders in your market that are doing micro business lending. One's a community development credit union, and another is a CDFI. And trying to look a little bit at how the market, to what extent the markets you're trying to reach may overlap or may diverge, may give you and a sense of that may help you to figure out, is there some way that you can pick some niches in the market where you may be able to experience some growth. So those are some other thoughts that we've discussed to some extent in terms of thinking about moving forward in terms of strategy.
Very good advice, Joyce. You're right. Yep.
So with that, I'm going to just ask quickly whether folks have other questions or comments for Martin, because we do want to move on and hear a little bit about what's going on with coastal enterprises as well. So, and I note that, Marion asked some questions about, Marion, you asked a question that, the ultimate measure of success are their outcomes and what they're seeing in terms of business income and growth. And I know that Martin and Josh are going to follow along on the outcomes process and think about picking that up possibly, I think, next year. But as we know, just the data endeavor that they're engaged in right now, I think, is pretty sufficient in terms of giving them some things to think through. So. Okay, if folks have other comments, feel free to chat them in. But I'm going to start moving on to our conversation and our analysis of where we are with coastal enterprises. But we've gotten a bit less far in terms of our analysis with that group, in part because coastal had a pretty ambitious analytic agenda. So as a reminder, we're working with Jennifer and Elizabeth at Coastal, and their central question was whether in their loan portfolio there are indicators that predict or are present in better performing microloans. And in particular, their hypothesis was whether stricter underwriting criteria lead to a better performing portfolio. And again, just to give you a little background on the context at Coastal, a couple of years ago the organization did a big review of their lending program, and that review led to some changes in underwriting and some tightening of, I think, some of their underwriting practices. And they led to some questions in Jennifer's part as to whether, in particular, whether an increased focus on collateral was improving performance, or whether, in fact, tightening up on some of the underwriting criteria, particularly around collateral, is leading them to not make loans that they should be making. And so the challenge we have here is that answering this question takes more than just the kind of benchmarking analysis that we just highlighted in our discussion of Community Capital of Vermont. So what we've been doing with Coastal is exploring a couple of different types of analysis that might yield them some insights as it relates to this question that they've posed about whether there are indicators that predict better performance in terms of the microloan portfolio. So the first kind of analysis, and the one that the team at Coastal is most interested in, is of course the hardest and the most challenging one. And what that would involve is doing a regression analysis that uses historic data from their loan files on the various characteristics of loans made over the past 5 years to see which factors appear to have an effect on loan performance. And so to do this kind of regression analysis, what you need to do, first of all, is determine what constitutes, in this case, a bad loan. So what we're trying to figure out is, are there certain characteristics that correlate with a loan that goes bad? And the first thing you have to do is define what you mean by a bad loan. So is any loan that's written off, is that a bad loan? Or from the purposes of the analysis, would you say, any loan that we've made that goes more than, say, 60 days or that was ever delinquent is a loan we wish we hadn't made? And so we really want to understand, what factors correlate with that kind of what we call a bad loan. So when we talked with the folks at Coastal about that, we identified that if we used the criteria of loans that had been written off, they had 26 loans over the last 5 years that had been written off, and they're thinking about whether they want to broaden that to some extent. But and so that's part of the process. And the next part of the process means just collecting data on factors related to each of the loans in that historic portfolio. So going back to the loan files and seeing, obviously there's data on the size of the loan, but if there's data in the file about collateral coverage and cash flow coverage and business status, because what the process would be is building a database that has all those factors in it, and then you do a statistical analysis on that data to see which of those factors seem to have a statistically significant and impact on whether the loan goes bad or not. So what we had to do was, first of all, get a sense of whether Coastal had enough data to be able to do a sound regression analysis. And they went back and looked at their files, and they saw over 5 years they had 222 loan clients over that period. And again, we mentioned that 26 of those loans have been written off. So what we did on our end is we went and consulted with a couple of economists, and we wanted to know, could you really do a valid analysis with a database of that size? And we also checked with them to say, is there a simpler kind of correlation analysis that we could do that would have some validity to us? And what we got back from them was the answer that yes, Coastal has enough data to draw conclusions about their current loan methodology and clients. They don't have enough data to be able to generalize beyond folks who they're serving using their particular underwriting criteria, but they could go back and look at what factors using their current methodology seem to have been predictive over time. And they also told us that unfortunately the correlation analysis that would be simpler and easier to do they didn't think would really be powerful enough. It wouldn't really take into account the fact that there are multiple factors that affect performance. So the challenge that we have right now is that we're talking about a pretty sophisticated type of analysis that takes specialized expertise and also takes a good chunk of time, probably about 10 days of someone's time to do. So, and there's also the process of again, compiling the database based on what's in Coastal's loan files. So while the team at Coastal felt they were up for the challenge of putting together the database, they don't really have the resources to bring in an external consultant to do that work. So one of the things we're looking at doing right now is submitting a proposal to a group called Data Without Borders that can provide support to nonprofits in terms of pro bono or reduced cost assistance, and they'll help you with various kinds of data analysis that you want to do. So that's one piece that we're thinking about doing. And Jennifer and Elizabeth, any comments you want to share regarding the process of exploring the regression analysis?
This is Jennifer. No, I mean, I'm pretty excited to get I want the information today. I think that's the only, but I guess we're very interested to see if it'll actually give us good information.
Okay.
Yeah,
and one of the things we wanted to pose to the group was whether anyone in the group has had any experience in terms of trying to find external affordable resources for doing this, some more advanced statistical research that they want to point us to. We've looked at this group, Data Without Borders, and we're going to try to approach them, but I don't know if others have any suggestions or thoughts. If you do, please feel free to chat them to us, and we will share them with the group and follow up with them. So that's the first piece. We're really trying to figure out if there's a way that we can do this more sophisticated kind of analysis that would give this predictive data. So we're also recommending that Coastal look at another kind of analysis, which is what we call a vintage chart on their portfolio. And this is, again, one of the kinds of analysis that we talked about in the beginning that Tamara referenced, which is really where an organization's looking at comparisons of itself over time, at looking on a yearly basis to compare and see how its performance have changed. And what a vintage chart does is it looks at the organization's loss rates based on the year of origination of their loans. And it tells you what the percent of loans that were written off at each month of the term of a loan. And so this is a sample chart. And we sent actually a spreadsheet that Coastal could use and by plugging in data from its loan portfolio, we could use to generate this kind of chart. And this is sort of a fictional chart where we've plugged in data that's not from any real organization, but it gives you a sense of what this analysis could look at. And if you look at this chart, it shows, it's the sample chart, it shows loans for the years 2003 to 2007. And it basically shows you two things for this fictional organization. The first thing that it shows you is that loans that were made in 2004 performed the best. So you can see that's the pink line, and has the lowest loss rates. You saw that overall the loans had about a 6% loss rate. And it shows you that the loans made in 2006, which is the turquoise line, performed the worst. You can see that those loans are already up to a 14% loss rate. The other thing that the chart shows you when you look at it is that the time when most loans go bad is between about year 1 and year 2 of the loan. So because what you see here is that the slope of these lines really jumps between month 10 or 12 and month sort of 24 or 25. And these are the ranges in which the slope of the loan, the slope of the line really increases, and in most cases it starts to flatten out after about month 25. So again, it suggests that what this would tell an organization is that it's really between years 1 and 2 that they seem to see the most problems in their loans, and that might give them a clue that what they want to do is think about focusing some of either their post-loan TA and their collections energy in loans that are in that time period. So we've, as I said, we've suggested that that coastals take a look at doing this kind of analysis, and it'll give them a sense of whether they've really seen fluctuating levels of performance over time and what might have been going on in those years where they might have seen better or worse loan performance. They might also be able to peg the analysis to when they really tightened up their underwriting criteria to see if that seems to have made a difference. So Jennifer and Elizabeth, now do you want to comment briefly on what you're thinking about in terms of the vintage analysis? I think you guys are still looking into whether your loan servicing department can generate that data for you. Is that correct?
This is Elizabeth. Yeah, that's correct. I think the biggest challenge we're facing right now is that the little bits of data are all held by various departments in a sort of larger organization. So just getting coordination between all the departments is one of our biggest struggles.
Yeah, and I think, this is Jennifer, I think that we definitely want to do this. It's just a matter of getting the data and devoting some time to it, because I think, as we've mentioned, I mean, as Joyce mentioned, we are in the process, we actually are still in the process of completing this analysis of our loan portfolio. So this bit of work is actually very timely for developing the plan to go forward, and these vintage charts, when we get them, will also help inform how we target businesses. So. Okay.
Great, and we had a question come in from Martin from Community Capital about whether we can share the vintage spreadsheet, and the answer is yes. So if folks are interested in that tool and applying it to their loan portfolios, we can share that spreadsheet as well, and that's a tool that you could use to generate this kind of analysis. So. Okay, what I want to do now is move to, because we're getting kind of close on time, and we do want to give a report to about what some of the other groups are doing, not just the lending group. Is the last kind of analysis is we have suggested to Jennifer and Elizabeth that Coastal also do just some of the straight up benchmarking stuff and benchmarking analysis that we've done with Community Capital of Vermont as they think about how they're looking at their lending portfolio and think about how they compare themselves to their peers in their industry. And the challenge here is really in terms of pulling together comparable data for Coastal. And I know that Josh talked a little bit about some of the challenges for Community Capital, but in Coastal's case they're a little bit more daunting even. And the reason for that is because Coastal is both a large CDFI that does a whole range of larger business lending in addition to its micro-lending, and also in terms of its micro-lending activity, it not only does lending, but it does a significant amount of training and technical assistance. And so what that means is the process of separating out their micro activity from their broader activities that include small business activity is a little bit challenging because many people in their staff work on, for example, their lenders work both on lending microloans and on larger business loans. And also the process of teasing out their lending costs from their training costs is a little bit challenging. So just to give you an example, Coastal Enterprise has 105 different sources of loan capital in its lending portfolio. And some of those can be used exclusively for microlending, so they might be easy to pull out. Those are their, for example, their SBA microloans. But they have other capital sources that can be used for both microlending and larger small business lending. And so trying to tease out, for example, what the deployment rate is of their microloan capital just becomes a little challenging. And so what we've done is ask Jennifer to just figure out which lending-related measures are the most important for her, and we're going to start by tackling trying to get some comparable data on those. So Jennifer, I don't know if you want to just briefly share which measures you think you're most interested in looking at right now.
Well, sure. Of course, the ones I want are the ones that are going to be the most challenging to get based on how we track our data. So and for some reason I didn't check them off. I'm looking at what you sent me. But I think my focus is on, even with the work we're doing, is on figuring out efficiencies. And so even though it's really hard to track dollar amounts we spend on things, that's what I want to ultimately do. And so I think we're going to have to be comfortable with some loose numbers that are, they're not exact, but they're enough to at least calculate our cost rates and our efficiency. So.
Great. And we have some protocols that we've used in the past, because you're not the first group that's gone through microtest that has this challenge. And we're also thinking, just so folks know, that we may be able to tweak those or even improve them so we can make it easier for folks to do going forward. So that's where we are with Coastal. I'm going to turn it, if folks have comments or questions, feel free to go ahead and chat them into us. But I know we don't have that much time left, so I'm going to go ahead and turn it back over to Tamara to report on what some of the other groups are doing. And again, if folks have questions that you want to chat into us while Tamara's doing that closing piece, please do, and we'll answer them via the chat.
Okay, great. Thanks so much, Joyce. And it was Luz and all of the folks in the lending group. For me, it's been great to see the results of the work thus far, and I think it's really encouraging and helps show our other two clusters the type of results and process that they'll be going through, and really results that they'll have in just a very few short months. So I just wanted to provide an update on what the rest of you have been doing in the other two learning clusters, the BDS group and the SROI group. And just to let everybody know that we've had discussions with each of you to review your learning questions and lay out a work plan, and then for many of you to get you really started on this process. And I think that, and we certainly heard elements of this in the presentation today, that this is a really important part of the work, because it kind of takes everybody from the wouldn't it be great stage to the wow, all of those questions require a lot of work, and so maybe what we need to focus on and kind of hone down is. And that, I know, is where the groups that I have been working with are kind of trying to refine and make sure that they're actually going to be able to achieve answering some of their key questions. But I wanted to talk for a minute about the outcome survey, because everyone in the SROI group and likely everyone in the BDS group will be conducting the microtest outcome survey along with many other microtest members in May and June. And we held a webinar last week to help you get ready for that process. It was called Managing the Client Outcomes Survey, and it laid out what the steps you have to take before you're ready to start interviewing your clients, what the tools and supports that we offer to help you as you take the survey on. And just to say that if you missed that webinar, because I know there were definitely folks that were not able to attend, that please access it through the Microtest Members Only page. So there's the link to the actual Members Only page is on the slide here, as well as the login and password for that. And you can find the link to the webinar, so you'll be able to watch it as soon as possible. And you'll also, on that same page, all the materials and supports are there as well. So the actual Excel survey tool, the instructions guide, how to draw your random sample, tools like tools to help you schedule your interviews, and so on. All of that is right there in one spot under the Outcomes banner. But if you recall, those in the BDS group, because I want to talk for a minute now about what each group are really working on. So the folks in the BDS group are focused mostly on internal benchmarking. So how do one set of clients compare to other sets of clients? And generally these clients are receiving different types and amounts of service. At least one group has extensive data that they've collected over the past several years and will be mining that data in addition to new outcomes data that they collect. So this group, JEDI, will present what they are learning in our next whole group webinar that we're targeting for June. And there are 2 more organizations that we've asked to look at the data that they have to see if they also have data available already that they can add to anything new that they would collect in order to have the most robust data set possible. So that's Renaissance and Work are those 2 that are still kind of finalizing that. And then we have one other organization, Women's Economic Ventures, or WEAVE, that has already completed this type of analysis and decided that new data is definitely going to be required. And so they will be moving ahead, as many of the rest of you are as well, with doing their outcome surveys, getting started as soon as possible and wrapping up in early June. So that then they'll have completed data to mine and explore in terms of their research questions and looking at whether specific client characteristics and various types or lengths of service can be correlated with specific outcomes they're interested in. So that's where that group is, and just a refresher on what they're really looking at. The SROI group has also had work plan calls with Marion and myself, and these groups are all preparing for this year's client outcomes survey process, and they'll be completing their surveys by the end of June. And in addition to the core questions in the microtest survey, they're determining if there are additional questions that they need to add in order to fully address their own research questions. So that's something everybody's nailing down pretty much right now this week. And this group is really focused on exploring outcomes beyond just those accruing to the client. So for example, some are interested in jobs created, or others in the rates at which low-income individuals are moving out of poverty. And they're interested in looking at this in comparison to others. So sometimes to others in the industry, similar to the peer comparisons we saw today, but also in relation to other economic development strategies. And some are really interested in looking at their cost per measures. Some focused on kind of ones we find in the program performance data, like cost per loan and cost per client, some of which we saw today, and others that are focused really more on cost per outcome measure. So an example would be cost per business start or cost per job created. So these groups will be launching their outcome survey and then finalizing their performance data in order to have their raw data to analyze. And then they'll be working with Marion to be able to compare their data to others in the microenterprise field using MicroTracker where possible, similar to the kind of overview that Luz gave us today, as well as drawing on external sources of data for additional comparisons. And in the initial discussions that we've had with the groups, 2 of the groups have already identified external sources of data that they can use, that they already have identified and can use for comparisons. So that is great that they already know at least one source of external data that they plan to use for those comparisons. So that's just a quick update on where everybody is. I want to thank everybody for participating today. We're really excited about your projects and what you're learning, and we're looking forward to seeing what the summer brings. I just remember that if you haven't watched the Outcomes webinar, the time will come up very quickly, so please do that. And then I will also be sending out an email to everybody about next steps in the Outcomes process, so keep an eye out. And then we'll be sending out a doodle poll soon to get the June webinar date nailed down. And then finally, just for those of you that are going to be at AEO next week, the AEO National Conference, I know there's some of you, we look forward to seeing you and having lunch together on Tuesday. We will just have a table with a Prime MicroTracker sign-on run it in the big lunch hall, and so come find us, and that way we'll be able to sit together and then share the networking time after lunch. And then also just come say hi. We'll have a microtracker booth in the exhibition hall. So if you want to have a chance to have us actually walk you through any of the features we showed you quickly today, that would be great, and you'll be able to play around. If you're having any trouble, we can troubleshoot that for you as well. So thank you to our presenters and to Joyce and Luz for the work that they have already done with the groups, and we look forward to seeing some of you next week and then reconvening as a whole group in June on our next webinar. So thanks, everybody.